everybody, wanted to look at a stock that pretty much everyone knows here, consumer stock, Walt Disney. Let's see what's going on with the stock. Over the last 5 years, you can see the stock has gone roughly lower. In fact, the stock's trading $89 today. That is at nearly an all-time low. Why is this happening? Well, we've got to look at the past first. Let's take a look at margins here. So let's go back to 2015, and as you can see, this is Bob Iger's heyday. They're doing $52 billion in revenue up here, and their net income margin, the amount of money they're making on that $52 billion, 17%. Very healthy, strong margins here. In fact, you can see all the way through the 2015, 2016, 17, and 18, super consistent margins. However, let's take a look at what's happening in the pre-COVID era that changed substantially. Now, as you can see here, 17% margins became 12% margins down here. This is even before COVID, so there was no pass here. What's happening to make those margins go down? Well, they're creating a bunch of movies that are very expensive. Marvel movies, Avengers movies, and people are going to the movies a little bit less, so that's a bit of a pain point for them. But the real pain point is cable. Cord cutters and Netflix choosers are running away from cable, which is hurting their subscriber numbers, and there was no bigger subscriber cost than ESPN and Disney Channel. There were 6-8 channels, they were all very expensive, and so this is hurting Disney and hurting their margins substantially. As you can see here, after 2019, we get into the COVID era, which you get a bit of a pass on margins here, but they're still declining 10%. 4% in 2021, really poor margins there. And then as they're coming back in 2026, you'd think those margins would expect to go back higher. They really didn't do that much, and that is why the CEO got fired and why Bob Iger had to come back. Now let's take a look at the future as to see whether this stock is going to be better going forward. So then now let's take a look at the present day here. You can see margins ticking up from bottom of 4%, 7%, and expectations for these margins continue to go a little bit higher. This is what Bob Iger is in there fixing right now. He is in there making sure that they don't create movies that can't absolutely explode at the box office. He's trying to fix the direct-to-consumer cable business versus the cable business, the change that's going on there. He's trying to make sure that they don't waste on content. And if you believe these numbers, let's take a look at 2025. EBITDA is about $20 billion. Compare that to an enterprise value of 207, and you're about 11 times EBITDA right here out in this year. Net income multiple about 21 times, and the free cash flow yield right here probably about 4-ish%. All in all, these are very fair valuations for a really strong company like Disney that has a lot of levers to pull, that isn't going anywhere anytime soon, that is going to be around for 30, 40 years, can probably raise price substantially in certain areas, right? So fair valuation. Margins have troughed. If you believe margins are going to expand very quickly in the near future, this company could have a really good run here in the near future. If you think they're going to continue to languish and they're going to have difficulty, then the stock may continue to struggle. So a lot to like about Disney down here. You've got to really love the margin picture to love it. You've got to love what Iger is doing, and if you like all that, then there's a lot to love here. Thanks for joining us today. If you guys have any questions, any thoughts you want to hit, you can hit us at river1.us on the web. We're also on LinkedIn, YouTube, and we're also on Twitter. Anyway, just DM us. Let us know what you're interested in. We'd love to reach out to you and chat. Thanks so much for watching. We appreciate it.